Good weekend, all. Ira Epstein of Linn Associates with your agriculture update with your weekend edition for this April 26th, Friday, 2019. Now, as you probably know, I haven't been around for the past couple of days. As we get older, we have parents that get very sick as time goes on, unfortunately. I had that happen. I can't tell you that my schedule's back to normal quite yet, but I'm working on it. I didn't want to miss out on the weekend update for you, so here I am. For those of you that are subscribers to my research, you know I've kept up with it. Even as I'm taking care in the hospital, I'm putting out my updates and so on to keep my own sanity. In looking at the grain market, maybe corn finally is getting to an area in the 350 zone where it's got some value. That's the question people will ask. Beans are down now, back another 5 3/4 at 867. There's still no deal yet with China. We know that they keep pushing for the deal. April 29th, I believe our mission goes to China, and then right after that, the week after that, the Chinese come here. Will we wrap up a deal in May? Your guess is as good as anyone else's. We're hoping so. The other thing that's happened is, you know, the dollar's gotten up near 9,800 on a basket of currencies, which makes our goods that much more expensive and problematic. And of course, you're always fighting with the stock market that has been on a tear to the upside. When we look at a monthly area chart of closes, the one thing that's evident is the market has not been able to get back up to the 18-month moving average of closes, which is the red line, currently around the 927 level. Now the market's falling back, but it still hasn't broken through these really important lows all the way back here. And if I come there for you, we're talking back August 31st of last year, the market settled at 833, and from there it's had a bit of a bounce. This one bounce here was at 839, so you're still above those lows. That's about all that I could say. Will they hold? That's what the market's going to find out. When we take a look on a weekly chart, and that's what we do, we look at a monthly chart first, then a weekly on this Friday edition, we've gone from this high area of 1071 that we made way back here, as you can see, the March time frame of 2018, to 810.5 as a low back in July of last year, got our bounce, and then we failed against the 38% range, and we've been coming down. I'll say it again. The big question is, does the market make another run for those lows or not? When we take a look at the swing line study, which gives us an idea as the market trending via the definition of lower highs, lower lows, higher highs, higher lows for an uptrend, we're in a downtrend. We have lower highs, lower lows as this indicator measures. I created the indicator, and I can tell you it looks at inside days, outside days. If you take our charting course, it's all explained there. To break this downtrend on the current chart formation, you'd have to take out 907.25, which is about 54 cents away. The market fought a battle at the 18-week moving average of closes, never did make it to the 100. And in terms of support, one of the things I always look at are where the Bollinger Bands. Now, if we come back 1 week, we can see the market was fighting a battle against that band and had been doing so for about 7-8 weeks. Now it's pushing through it. Keep in the back of your mind, whether it's a weekly chart or a daily chart, monthly chart, the odds of staying under or over Bollinger Bands initially are only 5% of the time. So yes, the market's pushing the market down. Yes, the market's in a downtrend as defined by the swing line. And because it's underneath the 18-week moving average of closes, the bias is down. The last part of the puzzle are the slow stochastics, which is the measurement oscillator of momentum in the market. On the weekly chart, I don't look to see if it gets overbought or oversold. I just purely look, is the market pointing up or down in momentum? And in this market, it's pointing down. So we have a market in a downtrend trying to break out of sideways action. If it does that, could the $8 area be the next target? By the way, on the way up, I would expect resistance at the 18-week average at 899. In the meal market, we've been in this sideways band as measured by the Bollinger Bands if we go all the way back to the first part of the year. You had come down, and this is through the June time frame, and we've been really on the longer term scale very much in sideways action. The market has picked up a downtrend in the lower high, lower low. It is just now getting down the challenge, just missed it by about 30 cents. The lower Bollinger Band momentum's pointing down. I would expect the bears to defend the position at the 18-week average should it get up there. And if you cleared 311.80, I think the bears have lost their case and you can go back into a chop area. In soy oil, this is the first challenge of the lower Bollinger Band. When you challenged it before, you got to bounce. I have no reason to suspect different. In other words, the first challenge of an upward Bollinger Band or a downward often is an area where the pros take some money off the table. I have no reason to think different in this case. Momentum still pointing down. It did not have the power to close under the lower Bollinger Band, nor is it in the sideways pattern here like you're in beans and meal. If we come to the corn market, this never had the sideways pattern either. It's just been falling down and it's accelerating to the downside. So markets that don't go sideways, the question is how far down can they go and how long? Now, if we look at the lower Bollinger Band, it's 350.25. You managed to rescue yourself today by getting back to 351.25. We'll see if the market can stay with that. In the wheat market, the trend is down. The resistance on the last rally was back to the 100-week moving average of closes, and it failed there. The lower Bollinger Band could be the next target. The market last low was 422.25. Now the question is, does it get down and through that to prove it's a real bear market, or do we end up with the potential of lows that aren't as low as a previous break low? At this point, I would expect bears to still very aggressively protect their short positions between, if you had a hard rally, 477 to 483, and the target right now could be wherever that lower Bollinger Band comes in. In the cocoa market, we went up, if you'll recall, back here. This was the week of March 29th. It sounds so far ago. This is only April 26th, so it's not far ago. And the market created a pattern of higher lows, lower highs. Then it went up, challenged the upper Bollinger Band. I'll stay with my thinking. Whether it's a weekly or daily chart, the first challenge is often a failure area. The market followed through the next week. Now it's pulling back, and all of a sudden it's right back to the 18-week moving average of closes in red. Momentum has stalled, but still pointing up. The trend is up. I would expect the bulls to try to defend their position on the weekly chart right in this general area. In the sugar market, it's looking more and more like a market trying to break out to the downside. You've got lower highs, lower lows, and outside week down. That puts into play the potential for the lower Bollinger Band to be challenged of 1196. I would think the bears want to defend their positions in the 1260s. Now, often, the word is not always, it's often. If you take out the high of an outside week within the week after that, 2-week period, it creates what I call a bear trap. And the market often takes a look above it to see where the next resistance zone might be. It could be the 100-week average or the upper Bollinger Band. Right now, I'm going to give the nod to the bears. They've got control of the market. In the coffee market, you still got momentum that has carried the market to the lower Bollinger Band, and I'm going to say it again. Didn't quite hit the Bollinger Band there. You certainly did there, bounced away, and you're getting a little bounce. So that's all that it is. So far, it's not a change of trend. Resistance, you're still under the 18-week moving average. To get to that number, though, you'd have to take out this high right here of 96.95 because that number is 97.81. I don't think the bears would defend overly aggressive if that happened. You'd break this big pattern in this big break area. In the cotton market, the question is, you've run into resistance at the 100-week average. Does it join the bean market coming down? Does it start thinking, no, there's good things coming with the Chinese trade deal? You're right at that zone where the market has to make a decision. So far, the pattern has been higher lows, higher highs. If the market takes out 75.70, I'll call it a failure then at the 100-week average, and I would not be surprised if the market drops back to what I call that line in the sand. You'll often hear me say this in my daily videos, the 18-day moving average, and on this market, the 18-week would be that line in the sand. That number is very, very important. It's where markets try to figure out what to do next. Right now, the bulls have the upper hand. If they can get through this 100-week average, maybe they get to the 79.20 zone. The cattle market has failed. Now, I don't know if it's failing because the hogs did a certain amount of failure. We haven't seen the pork purchases out of China that the market was hoping for, but you do have an outside week down. You've got lower highs, lower lows. The bias is down since you closed under the 18-week average. Full play comes in against this 127.50 area if the bear market's going to follow. To knock out the trend, you'd have to take out this week's high of 128.87.5, which would put into play, if that occurred, of getting back to the potential of the Bollinger Band top, but right now bears have control. In the hog market, where you stalled out should come as no surprise. You had a breakout of a sideways action right here. And when that occurred, you first went up and stalled at the upper Bollinger Band on the 100-week average. Now, this is March 15th, about 5 weeks ago. Then the market got that news about Chinese purchases and blah, blah. The market got over the upper Bollinger Band, pulled back under it as is normal. You only stay over that band 5% of the time. The market got back over it, and now you're stalling. You closed this week at 8,700, and if you take a look, 89.55 is the upper Bollinger Band. It's a pullback. Did you break the major trend? No. You still have higher lows, higher highs. You're pulling back within a support area here. Now, if you take a look at the 18-week average to the 100-week, when you reopen on Monday, I would look for this market for the 18-week to get over that 100, which should cushion the market to a degree if traders look at crossovers of moving averages. You know, I explain this every morning, and even though I was out this week, you can ask my subscribers. I was putting out these updates 6 in the morning every morning, and that's what I try to do. Before 6:30, I start recording typically. By 7 a.m., typically I've got this posted, and this is what these videos will look like. I'm not in them. I've got a microphone. I'm talking over 45 charts, 40 of futures, about 5 of ETFs. And I'm doing a few more studies than you see here, as you can imagine. And what I'm trying to do is, if you have your own idea, I want to be your sounding board. I'm giving you reasons that I'm looking at to be long, to be short, buy here, sell there. And unlike these videos that you're watching me in right now, I can say, buy here, sell there. This is what I think you should do. The reason I can't do it here, and by the way, I cover all these sectors in the same manner each and every time, so you can pull the video along, is because the government says that to say buy here, sell there, you have to have it in a confined area for risk, so on and so forth. They're correct. So what I do is, it's a paid subscription. It's not expensive. If you haven't tried it, it's 26 cents a day. After that, you can decide you want to buy a 1-year subscription to it or go month to month. There's no contract with us. You decide what you're going to do. So as I said, the first 30 days, $7.95. That's 26.5 cents a day approximately. You can call my staff. Better yet, you can go right onto our website. Under education or research, as you go there, pull down to Ira's morning video. It'll explain everything, shows you how to do it, and you can sign up right there, and away you go. Certainly not expensive. I hope you find it worth the value. And if you're on the fence, maybe this idea gets you off that fence, either onto your idea or gives you a reason not to do it. That's